Hey there, everyone. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller. It's Friday, April 11th, and welcome to our special Friday all mailbag edition of the show. We will plan to do a brief market recap here before we get into some of the great questions we've received from you over the last week. Back home in Redmond, Washington, after coming back today from the Olympic Peninsula, enjoyable week there. Market activity and craziness aside, awesome to get away with the family, awesome to do some hiking, walking along the beach, enjoying the weather, which was kind of rainy and classic Seattle for this time of year, but also really good to be back home. We are coming to you from an overcast but beautifully cool Redmond, Washington today, and I hope you're all doing well and hanging in there regardless of how you weather this week in the markets. We'll talk about the nice rally today, from about 11:30 Eastern on. Nice recovery day for the markets, finishing in somewhat of a position of strength relative to yesterday for sure. Still a lot of open questions as we ignite earnings season big time starting next week. With that in mind, let's look at a brief market recap and see how things played out here on Friday, April 11th. We can see the major averages finishing all in the green here. The S&P 500, decent up day, 5364, we'll call it. And that's up around 1.8% from Thursday's close. The NASDAQ composite up 2.1%, and the Dow up 1.6%. Mid caps, small caps, all up as well. The small cap part of the markets up the least. We're up about 1.25%, we'll call it. The VIX drifting lower, but not by much. 3 points lower on the VIX, so still around 3750, we'll call it. And overall, I would say lower volatility, but still elevated volatility in a big way. Looking elsewhere around the markets here, we've got the yield curve generally drifting higher. The 10-year point around 4.5%. The long bond yield around 487, 5-year point around 416. So bonds continuing to sell off here generally, and yields going higher. Although the TLT, you can see the bond ETF was up a little bit here, which is kind of interesting, up about 0.5%. Is that true? Yields moving higher though, so sort of feels like bond prices drifting lower today. The dollar index definitely continuing lower. I did grab a chart of the dollar briefly just to show how that's continuing to the upside. Commodities, however, continuing to be quite strong. Gold and silver moving to the upside. Copper prices moving higher. Crude oil, natural gas, all in the green. Gold and silver. Gold was up 1.9%. Silver up 3.2%. That's using two of the commodity ETFs that we track. I do own GLD, continuing to make new all-time highs. If you look at gold, the spot gold or the gold future. Looking at cryptocurrencies, almost all in the green here. You can see Bitcoin pushing 84,000 just before we went live with the show. Nice appreciation through the course of the day after hitting a low around 78,500 during yesterday's session, continuing higher by about 5% today to currently sit around 83,250. Ether prices and most of the other top 10 coins moving to the upside. Again, Friday finishes with a decent end to the week. We did have earnings. We had some consumer data, but overall the market, drifting higher. Materials up almost 3%. Gold stocks continue to go higher. We highlighted Newmont Mining. I want to see on yesterday's show, continuing to see some upswing on that chart. Energy up 2.5%. Third from the top, technology up over 2% today. The worst performers were still up a decent amount. Communication services, consumer discretionary, utilities, your three bottom performers, but all of those higher than Thursday's close. Looking at the breadth conditions, overall, a nice up day. I feel like if you've paid attention as we track the breadth conditions day in, day out here on the show, it's been sort of a huge advancing day or a huge declining day. We haven't had one of those 50-50 days in quite some time. This week, it's sort of been feast or famine. Today, more feast, with the S&P 87% up, 13% down. The New York Stock Exchange 73% up, 26% down. Our market trend model appears to remain bearish on the short term and medium term. Long-term model turning bearish, it appears, for the mid caps and small caps. I'm going to update those charts, dig into them a little bit so I can report to my Market Misbehavior Premium members in our weekly flight plan coming out this Sunday. But overall, it appears after quite a noisy week, my market trend model not really changing at all. Broadcom, kind of an interesting chart to watch. This is one actively testing its 200-day moving average from below. I'm looking at Broadcom and Meta in particular, really testing that 200-day moving average. Anytime you see a market sort of in a transition period, I like to focus on some of those names, really testing key levels just to see if they have enough momentum to get above or if they're unable to do so. And a lot of times that can be sort of instructive about helping you understand general risk appetite and whether or not people are taking more aggressive bets. Broadcom, a decent update. Apple, a decent update. Nvidia, a decent update. This is why technology was toward the top of the leaderboard today. Again, Apple, if you ask me, a super head scratcher with the additional tariffs related to China. Doesn't seem like that's great for Apple's business. Market does not care, up another 4% today. Only 3 of the names down today. And Tesla, by the way, which we highlighted a couple times this week. Tesla, literally the definition of sideways. 0% change today after a bit of just a choppy flat session. Market carpet here, and again, I'll try to go quickly through the recap so we can get to some great questions from this week. I'm struck by the big gains in some of the big technology names in the upper left. Alphabet, bottom middle, also having a pretty decent day. Earnings really kicks off now with financials. So we've got JP Morgan, Wells Fargo, kind of one up, one down. Wells Fargo down about 1% after reporting earnings today. JP Morgan up about 4%. The payment processors like Visa and MasterCard continuing to bounce off of fairly weakened levels here through the course of this week. Also on the right side, I'm noting the strength in energy, noting the strength in materials, 2 sectors with most stocks in the green today. A lot to dig into there. I'll dig into that a little bit more over the weekend and see what sort of insights we can uncover. But for now, again, kind of a decent update for stocks. Just a quick look at some key charts here. The S&P 500 chart, obviously, we're continuing to drift higher. We had Wednesday's huge up day, Thursday's down day, and that's here, right? Cutting kind of the middle of the range from Wednesday's session. Today, an up day, sort of a bullish engulfing pattern type of day. Boy, what a crazy, noisy week. Just look at the range on some of these days here. So the fact that the week ends in a position of strength certainly is encouraging. If you're on the bull side here, I'd feel pretty good about how we finish this week after day one of earnings. That's not bad. I think there's a lot of news and reports to digest starting on Monday. But for now, kind of a decent push higher. I'm still watching this trend line off of the major highs. That gives us some room up to around 5,500, 5,550, and still count this a clear uptrend within a larger downturn. We start breaking that trend line, though. I don't know how I would be able to continue to label it as such, maybe something different. The dollar continuing to weaken. And again, stocks rallying today, dollar down big yesterday, down big again today. You're not seeing a big flight to US dollar denominated assets at this particular time. I think that's a concern when I think of what we learned this week. And again, in a crazy volatile week. Here's the TLT. So it did close slightly higher, but overall we can see we made a new low here. The momentum overall is weaker. I think this failed breakout in bond prices and then the rotation lower really suggests probably further downside in bonds before all is said and done. Here's gold making a new all-time high again today. We're over $3,200 an ounce for the first time. Still on gold in a couple different ETFs. Pretty happy with that position at this particular moment. What I'd mentioned, Meta, right? Hitting the 200-day on Wednesday, down from that level on Thursday. Today, not even making it up to retest it, right? If you draw a trend line, you can see we're still below trend line resistance. We're still below the 200-day. I think that's the sign that things are recovering from here, but not there yet. Broadcom also actively testing the 200-day close, almost exactly at the 200-day at the end of the week. Going into next week, we'll see. Obviously, technology, semis, decent up day. We'll see if there's enough of a follow through into next week. On the earnings side, JP Morgan reporting today. If you draw a trend line off these highs, I would say we're still probably holding that trend line or just briefly traded above it today. But I would love to see a push above that trend line resistance to complete a rotation. Stock was up 4% today. Wells Fargo also reporting, ended up closing down about 1%, similar to like Broadcom and Meta, struggling to get above the 200-day moving average. The reality is, even with all the noise this week, most stocks in the S&P are below their 200-day moving average. I start to get interested in the long side when more and more stocks regain that 200-day. Here's three names that are still below their 200-day moving average, even with all the noise and all the choppiness and some decent up days through the course of this week. I still think more to prove before I'm super excited about that. BlackRock, another great example as well. Here's a trend line from the January high, the March high. You can see where that is relative to current levels. We're down here. Again, a nice finish to the week in the financial sector, but still below trendline resistance, still below the 200-day moving average. I would love to see a move above that level before I would believe in an uptrend from here. All right, let's get to some of the great questions. As a reminder, I can see questions as we're live streaming. I see some questions coming in today. We'll capture all of those and get them in the mailbag on Friday's show. I'd love to take a little more time to answer some great questions we received during the week because we never have enough time to answer all of these questions. And let's get to the first one. Dave, I've read that moving averages are like freight trains. I love this one. Longer ones have more weight. How much weight do you give to weekly charts versus daily charts? And you had a couple other questions about the timing of moving averages and what sense to make of those. I mean, I guess the answer is it depends, right? I mean, if I'm bringing up a stock, my default sort of initial look is a 2-year daily chart with the 50 and 200-day moving averages on it. And I've done that so many times that I'm just super used to seeing the chart relative to the moving averages. And I'm immediately making an assessment on where is the price relative to the moving averages? Are they sloping up? Are they sloping down? Are we at or near certain levels? What's happened previously? Is this a stock that's bounced off of the 50-day? Is it something that recently broke through the 200-day? Those are all questions that I think just help you understand the basic technical setup before we can get into more specific analysis. But just the initial slope of the moving averages tells you a great sort of initial assessment and an appreciation to the longer term trends. And now you mentioned different timeframes, and I think that really depends on your investment horizon, right? So if I'm a swing trader, I probably wouldn't go any longer term than this. I'd probably go a little shorter term and either look at like the 5 and 20-day moving averages on like a 6-month chart, a 3-month chart, or look at an hourly chart and look at like the last 30 sessions. If I'm a longer term investor, right? If I'm more of a position trader, maybe I look at the weekly chart next. My default weekly chart has the 40 week, which is basically almost the same as the 200-day, and then the 150 week. And when you have a longer term trend in the stock, I found the 150 week is often a really good place to just appreciate some of the long-term levels. You can see Apple is one that we've been looking at here recently because it's had a number of pullbacks over the last couple of years, but they've usually stalled out at or slightly above the 150-week moving average. That's where we were over the last week. So understanding that and where we're at now relative to some of those previous moves, I would say super valuable. In terms of the longer ones have more weight, again, I think that depends on your time frame. That depends on your investment horizon. For someone, that could be, the 200-day could be much more meaningful because you're a little more longer term and you really want to understand the shape there. If you're a swing trader, maybe the 50-day or the 20-day exponential moving average is more helpful because you're trying to just identify some shorter term swings. So I don't think there's an absolute answer to that. I think the answer is with moving averages, with periods of indicators, you want to use ones that help you answer the questions you're trying to answer with your portfolio and with your universe. So the examples that I show you and the indicators with the settings that I'm showing you are all based around my own process that I've used for years, really trying to think about like the next month or two on average and just thinking about some of the longer term trends and how they relate to that. I do a little bit on the swing trading time frame. I definitely don't do anything shorter than that, like a day trading time frame. It's just not where I feel like I have an edge. It's not where I tend to play, and that probably comes from years and years working at big financial institutions where we were forbidden from doing any day trading. So I had to build a whole process away from that. Same reason why I don't trade options. I spent too much time at firms where I was not allowed to. So I had to develop an investment process for my own personal accounts that didn't involve derivatives. So that probably shaped how I approached the markets, the timeframes, the vehicles that I used because of firms I was at and what I was actually able to do. So that was a long-winded answer of saying it definitely depends. I would say one of the classic mistakes I see people making when they learn technical analysis is using charts and timeframes and periods that are mismatched to their investment goals. So think about your investment goals first. Think about what moves you are trying to understand and capture. Then use charts that will help you identify those moves effectively. That's how you arrive at the right moving averages for you. All right, next question. What would have to happen or what would you have to see to show the equal weighted S&P charts with the same frequency or in place of the cap weighted SPY? It's a really interesting question. That could be like a whole day long retreat. You could debate those sorts of things. What's so funny is I've interviewed a lot of people over the years, and hopefully you've seen the Market Misbehavior podcast, where I now interview a lot of really smart people and just try to ask them questions about their process and how they approach things. So we have the SPY and dollar sign SPX, which are the sort of traditional cap weighted indexes, and I think these are the most important indexes to watch because so many people have their investments tied in a direct or indirect way to this index, right? It's considered the main index in the US with all of its issues, with all of its flaws, with the fact that there's survivorship bias because stocks that don't do well get removed and stocks that are doing well get added. So there's a survivorship bias over time, right? I mean, it's not like you're looking at the same basket of stocks and how they move over time. That list changes when it suits the people at Standard & Poor's to make that change. Huge concentration problem, and that is an issue, right? Because the biggest names have a huge weight on the cap weighted benchmarks like the S&P and the Nasdaq 100. However, so many people use them for indications for investment. A lot of index funds are geared toward the S&P or something similar. So I think analyzing that as the market is super important. Now, you also have equal weighted versions of many ETFs. So RSP is an equal weighted S&P 500 ETF. So I would say, what would it take for me to show this instead of the regular S&P? I don't see it happening, honestly. Just because there's too many assets tied to cap weighted indexes and benchmarks. That's just the way the markets are set up. So looking at things like this as a secondary read, as a way of understanding a little bit more about what's driving the behavior in the S&P and the NASDAQ, I think this is where these ETFs and equal weighted indexes can have a lot of value. Looking at sectors and looking at equal weighted ETFs for consumer discretionary or technology or communication services, super valuable because then you eliminate the big overweight from the Magnificent Seven stocks, where 2 or 3 of those names make up half of the sector ETF. However, so many people buy and sell the XLY that I think ignoring that data series is a mistake. So I think you analyze the most widely used and invested in and popular ETFs as your primary analysis, and use equal weighted ETFs to understand a little bit more about the rest of the index, right? If the S&P is doing a certain thing, you can really look at Nvidia and Apple and Microsoft and Amazon. Then you can look at an equal weighted ETF and you get a sense of what's happening relative to the largest names and some of the smaller names. And when equal weighted ETFs start to outperform, that's when I think it's really, really helpful, right? When that trend, that relative performance changes. And I think that's why a ratio of the cap weighted index to the equal weighted index, super valuable. And a number of my guests that I've interviewed over the years have talked about some methodology using that sort of approach. So short answer is probably wouldn't happen because just not enough people invest in an equal weighted ETF for it to be super meaningful. Most institutions, it's really hard to replicate an equal weighted ETF in like a mutual fund just because of the weightings and all that kind of stuff. So most people don't do it. So it's less important to track that way, but very helpful, I think, for understanding the next level down of market behavior. Next question, the S&P monthly log chart with a trend line at the 1929 high. Talk about a long-term trend line, my friend, to the 2000 high, to the most recent high. How do you interpret that? Okay. I'll bite. Let's find out. So we got the S&P. You said do a monthly chart, go back 100 years. So we are taxing the depths of the stock charts database here. And then you said, okay, start with the trend line at the 1929 high. I don't know if I've ever looked at this particular thing that you're suggesting, but let's take a look. So 1929 high, draw it through the 2000 high, and then look at where we're at right now. Huh! Look at that. Interesting. I don't know if I've ever actually looked. Maybe I have. I just haven't thought about it. What does that mean? I mean, very interesting. This is a thinker. I like this one. So what you're basically saying is, right, take the peak before the Great Depression, connect that to the peak before the technology bubble. It lines up almost perfectly with the peak we've made. And this is on a log scale chart. So it's really looking at a consistent percent return. I mean, by the fact that you're answering this question, I'm guessing what you're seeing, which I get it, is the fact that are we just at the upper end of this, trend line? We're just retesting trend line resistance. I mean, maybe. I guess the question is, this is a trend line that's like a 70-year trend line from point A to point B, and then another 25 years to point C. I don't know if the markets have that much long-term memory or symmetry, because no one that's investing back here is still alive here, and to even be able to see this trend line play out. Is it a possibility that it's a huge trend line that's finally getting tested? Boy, maybe. But the other thing to remember, the time frames that you're operating on, looking at 100 years of history, it's just too long. It reminds me of when you're looking at like demographic studies. If you actually look at the statistics, one of the best indicators for or certainly a very compelling indicator for long term, I'm talking very long term trends, is the demographic curve, right? So if countries that have a period, they have a huge generation coming in, right? Baby boomers, big generation post World War II, all of a sudden there's a ton of economic growth when they all get to certain ages, because there's just more people than normal buying houses, investing, all these kind of things. Some generations are a lot smaller, and as a result, there's an issue there. In like Japan, you had an issue where it's sort of like upside down, where there weren't enough, or China, where there's not enough young people. So you have like this very old group, this old, society where there's just more old people than young people. And so there aren't just a lot of younger people coming in, investing and doing all these sorts of things. And so that actually is a pretty good indicator. The problem is the timeframes on which demographics really help or hurt the markets are so long term that your window of actually investing and getting a job, investing money, and retiring, it's not long enough to actually benefit from those long-term swings. So it's more of like a multi-generational trend line we're looking at here. So that's my long-winded answer of like, boy, it's lining up very, very well. Does that mean we're going to be in a secular bear market for the next 10 years? I don't know if I would base that conclusion off of this particular chart, but now that you've asked about it, I'm going to save that one, and we'll come back to it in 20 years and see what happened. It's a really interesting point. I don't know. I'll think about that one. Again, at some point, I think with things like trend lines, with things like support and resistance, when you go back far enough, all of a sudden you have to really question, how much of that has meaning. Like for me personally, I started in the industry in 2000. So my sort of active awareness of the markets is from 2000 to 2025. I've read about the Asian financial crisis. I've read about the crash in 1987, but I was in junior high school at that point. I don't know if I really, maybe even less than that. I was in elementary school at that point. So it's like, I don't know if I'm really, I've read about that period, but I don't really have that active memory of seeing the markets and following them. I don't even think I knew that was happening at the time. I was more into to other things. So I don't know. Interesting point though, boy. That's a really interesting one. I can't stop thinking about it now that you've asked it. All right, 2 more questions. We'll continue on. What length of time would you think is too long a time frame to hold an inverse ETF? For instance, if there were to be like a secular bear market. I remember you had a longer question where you're asking about a number of different things, and said, you had pointed out the fact that inverse ETFs, there's like a tracking error of sorts, right? That the longer that you hold it, there's a natural degradation because of the way that these are actually using like derivatives and swaps and other things to replicate the movement of an index and create a leveraged version, or an inverse version, or an inverse leveraged version. They don't just go out and short the QQQ and then put it in an ETF. They're using derivatives to replicate that movement. And so it doesn't track perfectly, particularly over longer periods of time. So what happens is over a longer period of time, an inverse ETF isn't going to give you the exact exposure you think it might because it's doing it on a 1 day basis. That's how it's meant to calculate it from 1 day to the next. It's not meant to replicate an inverse behavior over months or years. So and the creators of the ETFs are very upfront about saying they were not intended as long-term vehicles, so you probably shouldn't do it. I've seen a lot of people, particularly if you're super bearish, buy something like the SQQQ and hope that it, if the market continues to sell off, would something like this go up? It would. I mean, that's kind of how the math would work out. Would it match? So if the QQQ is down 30%, would the SQQQ be up 30% over that exact period of time? Maybe it's going to be within some range of error around that. Would it probably go up in that environment? Yes, it definitely would, I would say, barring some huge structural issue or something. But overall, that's kind of the design of it. So it's one of those where the ETF creators, the ETF advisors would tell you not what it's intended for. So do it at your own risk. Generally speaking, they do move inversely to one another day to day. So over time, that's probably going to work. I would just say you'll get into trouble if you assume a certain percentage return over a longer period of time, because that's not what it's intended to do. It's not what it's designed to do. So those percentages may be very different. And again, just depending on liquidity and depending on how the market moves, you're going to have some variation. So it is going to be something like an inverse relationship leveraged in this case to the QQQ. It doesn't do exactly what you'd expect. So the short answer, what's the length of time? I mean, it was intended to trade during the day. I mean, it was a day trading vehicle. Having said that, holding it for longer periods of time, especially if you have a market outlook that you're trying to express by using this vehicle, I think you can hold it for a longer period of time. Just be aware, particularly if you're using leveraged ETFs like the SQQQ is an ultra pro short QQQ, right? So you're getting, leveraged exposure to an inverse percentage, which means it can go up a lot. It can also go down a lot. And so the excitement of having something like this go up a lot can be very good. The reality of it going down a lot more than you want is usually pretty painful for people. So I would just say, make sure you have your risk very clearly defined if you go dipping your toes in anything like that. All right, last question, then we'll call it a week here for chart this. For $CPCE, that's the equity put call ratio. What if it's so low because of calls on inverse equities, i.e. calls on SPXS and SQQQ? They are bearish, but buying calls on them will not be reflected in the $CPCE, or is that wrong? Okay, couple things to unpack on this one. Let's take a look. So let's go to my my sentiment list. I have a couple put call charts we can look at. All right, so this is the one you asked about, which is $CPCE. So this is the equity only put call ratio. So number one, when you're asking about SPXS and SQQQ, that would not be reflected here because this is only common stocks. I'm pretty sure that's right. I'm 98.8% sure that's correct. But you caught me off guard with this one. So this should not include ETFs in here. This is just equities, right? So it should just be options on Microsoft, Apple, Broadcom types of things. So SPXS and SQQQ are inverse ETFs, not inverse equities. So they're ETFs. So they wouldn't be included in CPCE because this is equities only. Now, what your question does make sense related to would be this one, not that one, this one, which is called the total put call ratio. This includes everything, which would include inverse ETFs in there. So let's think about this, assuming you're asking about this. And you actually sent this question in before when we were coming off of a pretty low level, and I've been saving it for when I thought it would be a good time to do it. And I thought it would be helpful given the spike we've seen in put call ratios. So to answer your question related to this, so if you're looking at the total put call ratio, would it include options on inverse ETFs? It would, which would mean if you're buying a call option on SPXS or SQQQ, which are inverse ETFs, leveraged ETFs, a call option here is actually a bearish bet on the markets because you're buying a call option on an inverse ETF. So to answer your question, yeah, that would be part of it. But the reality is, if you look at the average volume in the options market for the SPY or the QQQ relative to the daily options volume on like SQQQ, it's not even close. Like the volume on options for inverse ETFs is so small. It will affect it a little bit, but I mean, I'm talking tiny amounts you probably wouldn't even notice. The options in long related indexes and ETFs are, I mean, absolutely dominate relative to inverse ones. So the amount of options that are actually where that is true, where a bet would be an inverse bet on the markets, is so small. So the answer is it is included in the total put call ratio. Is it have enough of an impact to even think about it? It does not. And if you just look at, I mean, Google the average options volume on QQQ versus like SQQQ, I mean, it's got to be a tiny percentage, I would say, relatively speaking. So it is going to be in there a little bit. The problem with the total put call ratio, which is why you have the equity put call ratio at all, is because the total put call ratio has a bunch of stuff in there like this. And that's not the only thing. You've got other things, random things with options that are probably not a clear read on. And what you're trying to do is get a clear sense of investors making bullish or bearish bets. Now, the problem is the put call ratios in general, there are a lot of issues with this particular measure because, you know, you're assuming when you're looking at volumes on puts and calls that investors are just making, you know, if you're buying a call option, you're making a bet, a naked call that you're betting on the price going higher, or you're buying a put option and betting on the price go down. People use options for a lot of things with a lot of different motivations. So you're making a lot of assumptions already just looking at the put call ratio. But that would be the answer to your question. So short answer, CPCE is equities only. If you're looking at the total put call ratio, it does include those inverse ETF options, but it's just not that much to really impact it. So I think the general way of thinking where the put call ratio is very low, that tends to be bearish because it's an inverse reading, and the put call ratio tends to go very high when we're in a downtrend because people are making a lot of bearish bets, and that usually means as a contrarian, you look for a buy signal. That's pretty fair. So the fact that the put call ratio is up around 115, we can see some of the previous times the put call ratio has been that high. It's not at major tops. It's at some significant lows. I'm actually really glad you asked about the put call ratio. I haven't shown the chart of the put call ratio in I don't know how long, a while. Something I'll look at a little bit more, and maybe next week we'll feature it on the show. Thanks so much for asking about that, and so many other things as well. Folks, we'll call it a week. Thank you. I can't thank you enough again for being flexible this week. We had sort of a completely random broadcast schedule. That's what I tried to do over spring break, and I appreciate you hanging in and watching the content whenever it was available. I appreciate you so much doing that. Planning to be back here in Redmond and on a normal publishing schedule next week. So it should be back to normal here on Chart This, but have a fantastic weekend. I hope it's restful and joyful for all of you. And remember, it's always a good time to own good charts. Have a good weekend, folks.